All right, fam, welcome to the Three Kings Hustler Collab. This week we are on episode 10, talking about investment vehicles, what to use when investing. So, what are we talking about with this? So, like I said to you guys off air, this is probably the most underrated and under talked about conversation in relation to investments because it can be the most important. Everyone wants to focus on what do I buy and when do I buy, but no one talks about how you should buy it. And it can be really important because this is something that is a deferred strategy where what you do now will pay you dividends in the future in relation to tax, estate planning, security, all that stuff. So, what we need to consider when we're buying an asset and in which way we're going to buy it is we need to consider tax. Biggest one for me is tax, right? Tax is getting super with, especially with the government rolling out all this free money again. We can bet our bottom dollar is probably going to be some tax increases coming through us, right? So anything that we can minimize our tax on is good. But if you're not considering this with your investment, you're throwing returns away. Asset protection is the second one. So with any structure that you have, you want to look at tax as primary, but then you've got a secondary option. So if it's a good tax option, let's do it. If it's not a good tax option, then we've got to assess whether it's a good asset protection option. Okay, so protecting the asset from creditors, from divorces, from any liabilities that you may have. That's the secondary. Sometimes, even if it's not tax effective, it might make sense to protect the asset because the last thing you want is to lose an asset because you didn't protect it, right? Distributions, understanding how it can distribute out, who it can go to, and how it can transfer. Estate planning, what happens if you die? What happens to the asset if you die, and how can it transfer accordingly? And then what availability or ability does that investment have to hold certain investments? Yeah. So, what can you actually invest in inside that investment? So let's go through a couple. Now, there's a lot of words under each one of these. So I'm going to share my screen so you can see what I'm reading, so you can read along at home. Can you see that? Yeah, perfect. So the first one, the most common one, is personal name or individual investment, right? The most common, most simple. This is the one where you hold the investment in your own name. Okay, it's easy to set up and easy to manage as the income and capital gains are included in your own tax return. It's easy to administer as there is much less paperwork in comparison to other structures, much less expensive to set up and run. More tax effective, especially if the investment is negatively geared, more tax effective in your own tax name, not as a net tax benefit. Tax advantage if the investment is a family home. So if, obviously a family home is something you want to own in your own name for the tax benefits there. However, if the asset is held by an individual, it offers no flexibility with distribution of income. Individuals in high risk occupations could be sued and their assets exposed from risk credits, so lack of asset protection. Negatively geared assets held by an individual eventually become positively geared, resulting in increased tax liability over time. The same advantages and disadvantages apply to assets held jointly, which is a partnership, which we'll go to next. So what you got to understand is when you hold an asset in your name, and this is where accountants fuck up all the time, they look good as a short-term tax benefit because you can claim tax, it's called a tax deferral system. But the biggest problem with your own name is that down the line, when the asset gets bigger, when your income is higher, that's where the problem is because the tax that you're deferring today in the future may actually undo itself and you end up owing more tax in the future than what you saved on at the start. Okay. So it's really important that when you're doing tax strategies, and accountants are terrible at this because they're spastics and because they're absolute sharks, and they know that if they get you in on short-term tax deferral systems, you'll keep coming back. The amount of accountants I've pulled up at the start of a business strategy and looked at small business CGT exemptions, that kind of stuff, and saved clients millions of dollars at the start that they weren't going to do and they should have is ridiculous. Okay, so it's really important you understand that. Anything in your own name is the classic, because accountants know that all people care about is, can I get a big return this year? And if you hold assets in your own name, it increases your chance of bigger returns from negative gearing. But at some stage in the future, that's going to turn and your actual tax strategy is going to be fucking atrocious. Any questions on, you can chuck them in the chat, any questions on individual or personal name investing? This includes owning a business under that as well, the sole trader kind of thing.
Hi, I just have a question about why would someone do a tax deferral in the first place other than wanting the gains this year? Is it because they think...
So I'm not talking about actually deferring the tax in that year. I'm talking about the strategy being a tax deferral strategy. So you're trying to get a better tax return now for one that you're going to do in the future. The reason people would do that is because they don't know shit, right? They just think I'll get a better return, but they don't understand that in 20 years, the effects of that is going to mean a worse one. So I'm not actually saying you're deferring your tax purposely. It's a tax deferral strategy rather than an actual tax deferral process. Okay, does that answer it? Cool. All right, so partnership. Partnership is the same, essentially. The only difference is with a partnership is the partnership is an entity, okay? So as an individual, you are the entity. A partnership itself is an entity, but it is just treated the exact same as two individuals, okay? So the entity must distribute any gains, any income through to the individual, and then that individual be taxed as an individual, right? So to read the stuff here, so simple structure. It doesn't really get used anymore, to be fair. Requires its own tax file number and tax return. Does not pay tax, but must distribute income to the partners. Partnerships offer limited distribution flexibility as any income derived. Holding a property as joint tenants or holding shares in joint names usually not considered to be a partnership. There's no risk protection in a partnership. So the asset protection phase, because it's just a look through, there's just two individuals. There's no protection on that either. Either partner may be subject to claim by a creditor, as all partners are jointly and severally liable. This means that one partner becomes personally liable for all the debts of the entire partnership. So that it's not really that good. There's no real protection there. All it is two people saying we're going to operate as individuals under this entity and share everything 50-50 pretty much. Not great from asset protection, not great from a tax system. Just good, don't you? You see all those partnership businesses like lawyers and old school accountants. It was just easy for them to do shit that way. And they usually would have their own company off the back of that partnership and this and that, right? So it doesn't really get used very often anymore, only in very, very certain situations. Any questions on partnerships? Maz, feed me. All right. So companies. This is the big one, right? Any of you in business need to understand the difference between sole trader companies and the benefits as well as trusts, right? So we'll start with the company. So companies are most often used as a structure for business rather than for investment. However, you can use them for investments. The main benefit is that the tax rate on profits is 30%. It's not really, it's 27.5% for small businesses and 29.5% for big businesses, right? They offer some protection for shareholders if the business fails or is sued. However, there are also disadvantages, particularly for investments, as losses can only be offset against future income and a company is not able to obtain the benefit of any capital gains discount on the sale of investments. The cost of setup can be high, and there is a requirement for a separate set of accounts and tax return each year. A company can distribute profit by paying a dividend, but there is limited flexibility when paying these. Companies do have some advantages, though, and used appropriately, an overall investment strategy can work well for some investors. So that last sentence is really important. Companies are really good as part of a protection or a tax portfolio. Okay, they should be a filter in the stream of your money. The reason is a lot of vehicles, a lot of tax structures don't allow you to hold stuff. Okay, don't allow you to hold money. Almost all tax structures require you to pass money through via distributions. Companies are one of the only ones that you don't. Okay, so you can hold it. Now, if your personal tax rate is, and anyone who here owns over $40,000 a year, on average, your tax rate is going to be over 34.5%. That means that for anyone under that, it goes down to 19%. So anyone who earns over $40,000 a year, a company becomes a better taxable asset than your own name, right? So you distribute the money to yourself to achieve your own personal goals, and the company would retain the rest of the money and pay less tax overall. And then it would also offer a layer of protection in it as well. However, like I said, there is some cost involved and there is extra returns, etc., etc. So then we move into a trust, okay? Trusts are the most popular. However, you got to understand that trusts are very misguided and misunderstood. People think, just put something in a trust, no one can touch it. They're full of shit, right? Tax, asset protection and hiding money through trusts and bucket companies these days is very hard. The ATO has brought in all these rules, which is, there's one rule, part 9A, which is pretty much says, if we think you're doing anything for the main purpose of trying to minimize tax, you have to pay the tax, right? and they've got look-through provisions, which allow them to look through structures. It even allows them to look through a company and pinpoint a certain director or a certain employee in a company if the liability is bad enough, and say, you're not protected by the company, we're taking your personal assets, you dodgy motherfucker, right? So this stuff helps. It makes it harder, but don't ever let anyone sit here and say it's fucking bulletproof, because it's not. Okay, it just makes it better for you and a longer trail to sort of get away from. But nothing is fully protected. So trusts are a popular investment structure, but are often poorly understood. Briefly, the trust is formed by executing a deed which documents the establishment of the trust. The settlor gives the settled sum for the setup of the trust for the benefit of another person or persons called the beneficiaries. The settlor, often your accountant, is usually an independent person unrelated to the trustee or appointer of the trust, because the settlor cannot be a beneficiary of the trust. The settled sum is usually a nominal sum of 10 to 20 bucks. The trustee may be either a neutral person or persons or a company. The trustee determines to whom and in what proportion the income assets of the trust are distributed. Okay, so a trust, think of a trust like an umbrella. Yeah, trust is an umbrella that goes over your assets. The actual trust can't hold money. Okay, it can't hold money. It can hold assets within the trust, but anything that those assets generate must be distributed out of the trust. Okay, to the beneficiaries. Now, taking a step back, there is something called a trust deed. Okay, it's like the legal document that's written up for the trust that determines how the trust must be operated. It's obviously has guidelines based on law, what it can and can't do, but within that law, what you can choose, what assets you can have, what the purpose of the trust is, and whoever does the investing or anything in that trust must stick to the guidelines. That's how it operates itself as a separate entity from the person who's trying to set it up. Okay, that's how it's allowed to have benefits and protection benefits, because it's being operated as a different person, right? You're essentially like a third party managing everything inside there according to a legal document that tells it what must happen. That is governed by the trustee. Okay, so the trust deed, the deed to the trust, is governed by the trustee, who is the person that makes sure that the trust operates in that instance. The people who get the money and the benefit from the trust are the beneficiaries of the trust. All right, is everyone with me so far? Does that make sense? Okay, so the trust can hold assets, but any money, any benefit from those must be flown through to the beneficiaries in the way the trust deed says. The appointer has the power to nominate a successor on his or her death, and failing any such appointment, the personal representative of the appointer will become the new appointer. The specified beneficiary are usually the husband and wife or partner. Usually the husband, wife, partner, and so by definition, the range of beneficiaries include any children, any related entities, any companies of which the specified beneficiaries are directors or shareholders. So trust can be set up for families, they can be set up for children, they can set up for companies, whatever, right? The beneficiaries will be determined by whatever you're trying to achieve out of the back of that trust. Now, it's really important to understand that the more complex you make an investment vehicle, better it is for stuff, but the worse more complex it is for estate planning as well. So if you're going to set trusts and companies up, you need to ensure you have exit strategies from them that detail, whether it's in the trust deed or whatever, that detail what needs to happen in the event of a estate trigger, right? Or that if you die, if something happens, so that they can follow those rules, because it becomes very complex for those people looking after for you. Quick note on trust distributions at the moment, which changed about 3 years ago, that a lot of people still aren't aware of. The government imposed a tax on trust distributions to non-tax residents, right? Even if they aren't receiving, even if they aren't receiving distributions at the time. Sorry, I'll answer that in a second, Marcus. So even if they aren't receiving trust distributions at the time, that if they were not a non-tax resident of Australia, that that trust would be taxed doubly. Okay, so you need to be, if you have trust, if your parents have trust, because a lot of people in Australia have a diverse background and have family overseas. When an accountant or a lawyer helps you set up a trust, they tend to write in the trust very vague guidelines so you can include as many beneficiaries as possible. They'll include aunties, uncles, cousins, whatever. And that's so that you can include a lot of people. But if you have people in that category that are overseas, even if you don't know them, right? If you have a cousin, an auntie, whatever, they're overseas, because you haven't specifically named people and they're a cousin and they meet that definition, you'll be very careful because the tax office could definitely come back and say, your trust needs to be taxed doubly because you've got non-tax dependents as beneficiaries, even if you're not distributing to them, okay? So for you, for your family, you need to make sure that's something that they understand because you could be liable for it. They could be liable for a lot of money. So Marcus asked, can you set up business accounts in the trust, which is just your money generating in an account? Yeah, you can. So you can, a trust is essentially just an account, right? It's just something holding something. But the thing is, with the money in there for tax purposes, right? So you can't hold cash in the account, right? So you can have a business account that the trust holds, but for tax purposes, that money needs to hit somebody's account. Okay. So you can hold the actual bank account inside the trust, but when you go to report at tax time, that money needs to be associated with somebody's tax balance, essentially.
So what if the money isn't being paid out though? What if it's just generating in an account for, so I don't know, just say
they can't do that, Marcus, because cash is a personal asset. Cash has to hit somebody. Cash can't just sit in the nether realm unless it's inside a company or in someone's personal name. It has to be inside a taxable asset.
So it can be inside a company, inside a trust.
Yeah. So technically, if you had what you'd have is you have the trust. The trust would own assets. The trust would, and then the company would be the trustee of the trust, and you would therefore be a director of the company.
Yeah.
You can also have companies beneficiaries under a trust.
Yeah.
So that money would then be distributed that way, right? But the cash cannot be associated with the trust.
Okay.
Okay, because the trust isn't a taxable entity.
Yeah, I get it. That makes sense.
Yeah. So either end of the trust. So this is where the washing comes in. On either end of a trust, you have to have a taxable entity. So something has to come from something into the trust and then has to come out into a taxable asset, right? Has to make sure that it gets taxed at some point along the flow.
So could you have different companies in the one trust paying out different beneficiaries, or if it's one trust, are the beneficiaries entitled to every asset in the trust?
Depends on what the trust deed says. So the trust deed can outline that, 50-50 or it's for purpose or whatever.
Okay, yeah.
The trust has to operate in line with what that deed says.
Okay, cool.
Okay, where are we up to? A trust can distribute income and capital gains in accordance with the trust deed. However, it cannot distribute losses. Okay, this is a really big point on trust that's a downside. Losses can be carried forward to be offset against future income. A trust can also retain income, and if that income is taxable, then tax is payable at the top marginal rate plus the Medicare levy. Trust can also retain income. Oh yeah, correct. So when we say the trust cannot hold income, that's because if you do withhold it, it'll be taxed at the highest marginal rate. It's not smart, right? That's not a great tax strategy. What was the point before that I was supposed to say? Losses. So this is a big mistake a lot of people make when they transfer from, say, like an SMSF back to a retail fund, because an SMSF is just a trust. When a trust has a loss, if you wind that trust up, that loss disappears. Yeah. That loss can only be offset against gains within that trust at a future date. Okay. Really important to understand. So many people will jump into a self-managed super fund, which is a trust, and think, I'm going to do this. They'll have a loss. Fuck that. Wrap it up. Roll back into a retail or a wrap fund. And they've lost, say, the 30 grand of losses. If their fund gets back that 30 grand, that's tax-free gains. Now they're starting a new entity where the fund has to gain that 30 grand and pay tax on it, right? So really important to understand that you can only offset losses from that trust within that trust with other assets. So sometimes it's worthwhile buying more assets in that trust to try and offset it for future date rather than in your own name. There are four main types of trust. There's a discretionary, unit, hybrid, discretionary, unit, hybrid, and superannuation and testamentary trust, right? So, which are formed upon the death of a person who has specified its creation in a will and are discussed in estate planning. So, the testamentary trust we covered off briefly in in the estate planning stuff. That is, it's just essentially a discretionary trust, but it has a bit more guidelines, such as young beneficiaries are allowed to utilize the entire tax-free threshold instead of the 496 of young people. And there's some other things. Basically, you can it's created for you to control your wealth from the grave. Okay. So discretionary unit hybrid. Where are we up to? Note that Centrelink may include the income and asset of a trust when working out your social security payments if you are considered to be a controller of a trust. Further information can be found out. Discretionary trust. The trustees of a discretionary trust are able to distribute income and capital gains to beneficiaries in whatever way they desire, typically the most tax effective. So discretionary family trusts are the most common trusts that you'll see. That's where high income earners will try and just, they will distribute as much income. Now, it used to be heaps better when the 496 rule wasn't in. So anyone under 18 anyone under 18 that doesn't earn, doesn't have a job, they will get, it's 14 actually, sorry, they'll get taxed at highest marginal rate for any money over 496 a year. It used to be the full threshold. You could distribute all your money to your kids and you'd make bank, right? But that's why it got stopped. The assets of the trust are also protected in the event of litigation against beneficiaries, as there is no single individual that owns any assets, so therefore creditors of an individual cannot access any assets held by trust. A family trust election must also be made in some circumstances in order to distribute franking credits. In addition, franking credits cannot be distributed to beneficiaries unless the trust has net income. A company can be a beneficiary of a trust. Franking credits is where a company pays the tax on your behalf and you get a credit distributed to you on top of whatever your dividend is. Company can be a beneficiary of the trust, ensuring that the tax rate is capped at 30%. However, unless this distribution is actually paid to the company, there may be other tax consequences. For example, deemed dividends and Division 7A loan issues, which we don't need to go into. Beneficiaries who receive capital gains can claim the 50% capital gains discount where the asset has been held for more than 12 months. Unit trust. A unit trust is one where the assets are held and administered by the trustee. Sorry, is there any questions on discretionary trust first? Discretionary trust is the most common. It's the most one you'll use. Unit trusts are more for investments and companies trying to grow certain investments through them. Think of family trusts are more like a high income individual trying to minimize as much tax as they can in their own home. Yeah, it might be a business owner, somebody who's trying to gain more wealth for them. Unit trusts are more for collective investments. Testament trusts are for estate planning, and hybrid trusts are a mix of a couple, which we'll get to in a second. Unit trust where the assets held and administered by the trustee. The trust for the holders of units in the unit trust. This means that unit trusts predetermine the unit holders' entitlements, which may be for income, capital, or both. Unit trusts are often used where unrelated parties run a business together and where the units are then held by a family trust, and for managed funds where investors hold units in the trust. So your superannuation is a great example of a unit trust. Most of you, whoever holds industry funds or whatever. What happens is you don't actually own the asset, right? Or you're not a beneficiary of the asset. You're a beneficiary of the trust. So what will happen is everything that's withheld in that trust, right? So for example, in a family trust, the trustee could say, I want this beneficiary is entitled to 50% of this property or this share, whatever, right? They can really determine what happens. In a unit trust, everyone's equal shareholder. Yeah. So you actually own units in the unit trust, and those units represent a percentage of whatever's held within that trust. Okay. So you're buying units, or you have, as a beneficiary, you own a certain amount of units in the trust, which is spread evenly across the entire trust. And then what it's saying there is you can distribute that out into a family trust, which then can distribute to people. Then you can distribute the income from there onwards. They have limited application for most personal investments, although some use them to hold property, with the unit holder being a family trust. Hybrid trust. So hybrid discretionary trust become heaps popular. Can be a hybrid discretionary or hybrid unit trust. The former are the more common and take the best features of both discretionary and unit trust and mixes them together in the one entity to create a powerful and flexible tax planning solution. They typically use to gear into property where an individual will borrow to purchase units in the trust. And then when the property is no longer geared, the trust can repurchase the units, often borrowing money to do so. So a lot of business owners will do this with commercial property, and they'll do like a director's loan or a trust loan, right? So you'll buy the property, the trust will get lended for it, and then to cash out from that property straight away, the trust will lend you money as a person, right? That way you don't have to sell the asset, and you have money personally and the trust has its assets still. Care needs to be taken when establishing such a structure, as not all trust deeds are adequate to allow the individual to claim the tax deduction for the interest expense on the loan. For more detailed information, you can look it up. Does anyone have any questions on trusts? Very complex beast, very misunderstood. Like I said, think of it as an umbrella that money flows through, must be distributed. All right, so superannuation. Superannuation is technically a trust. Okay, money is a trust is just something that is held in trust for a future date for a beneficiary. That's what a trust is. That's why it's called a trust. Superannuation is the perfect type of trust. Okay, so superannuation funds are also a type of trust and are an investment vehicle which can be used to contain investments purchased with your superannuation contributions. So your superannuation is a trust, right? That's its essential overarching thing. Inside that trust is a platform, which is your super fund, right? If you have a self-managed super fund, you'll create the platform you'll have bank accounts, you will have investments, you'll have property, whatever it is, right? That's your platform, but they're all held inside in trust, right? All held in trust for you as the beneficiary at a later date. Inside your trust, inside your platform is then when your investments are held, okay? So this is where people think, superannuation is shit because it's risky. They don't understand the breakdown of it. Superannuation isn't just a thing, right? It's a trust that holds a platform that then holds your investments, and then that can break down further from there, okay? Now, to understand the benefits between these things, let's just run it quickly, right? Personal name was the first one. Personal name and partnership, they're taxed the same way. Personal name, you're taxed at your normal marginal tax rate. Anyone that earns over $40,000, you get taxed at 34.5%, including Medicare levy, right? So keep that number in mind, 34%, 34.5%. If you earn more, go all the way up to 49%. Then moving on from that, we have the company, okay? Company is taxed for small businesses at 27.5%, 29.5% for big businesses. So yeah, it's better for anyone who earns over $40,000. Then we have a trust. A lot of people think, trust is better. Trust isn't really any better on tax rate because what did we just discuss with trust? The income must be distributed. Where does it get distributed to? You as your personal income. Okay, so as a person, as an individual, doesn't really help you unless you've got other beneficiaries that you can benefit from essentially distributing to them and keeping the money, because you'll get taxed at 34.5% still. Then we've got superannuation, which is 15%. Yeah, 15% tax rate, by far the lowest tax rate. And then when you utilize it in retirement, at 0%. So this is really important to understand. When people are trying to set up companies and trusts and do all this shit, they often forget about superannuation, right? The only downside to it is you can't touch it till you're 60. But you've got to keep that in mind, because as far as tax goes, there's nothing else out there like it. Is the platform considered an asset then, since trust can't hold cash? No. So the platform isn't the asset, the platform holds the assets. Okay. So the platform will hold the assets, which will be anything, shares, property, whatever, right? Unlisted, listed, anything you can. However, it's a good question, Stefan, because the platform isn't the asset, it holds the asset, but the way the legislation works and the way that allows it to happen, that platform allows you to hold assets and internalize income distributions, okay? So keep in mind, a superannuation trust is its own kind of trust. It's not a discretionary trust. It's not a unit trust. You can actually hold unit trust inside of a superannuation trust, right? Because to have the rules of allowing income to not hit a personal tax rate, it has to operate in its own environment, all right? But it is still held in trust. The only difference is with family trusts and stuff is there's no future date. They hold it for the beneficiaries and they distribute. Whereas the superannuation trust must be held until preservation age. That's what the trust deed says. And then that allows you to hold assets and have income distribute within itself against its own tax rate of 15% and be redistributed back into the portfolio. Okay, it operates as its own entity rather than having to come to you as the entity and bounce back off of. All right, so that's the trust really. Does anyone have any questions on that front? No, cool. All right, so platform. So in simple terms, a platform is an administration service. It administrating service for your investments. In order to achieve adequate diversification, many people invest directly in a number of managed funds or shares, resulting in a deluge of paperwork. Instead, investing via a platform simplifies the management of multiple managed funds in your portfolio. Some investors also choose to invest through a platform to gain access to a range of investments that may not normally be available to retail investors. So platforms are common on superannuation, but they're also used for non-superannuation investments. A platform is just something that holds your investments. So if you want to hold investments directly and do all the work yourself, you generally use something like CommSec or Self-Wealth. Okay, that's direct. They're not platforms, they're direct trading service. Yeah. When we have a platform, the platform we pay a little bit of money for, and it allows all of our reporting, all of our tax, everything that we need done on that platform. It also gives us access to hold a wide range of assets, okay, that wouldn't otherwise be offered directly. And then it also allows us to get access to funds or to investments that may, if you were to go direct, you know, you see this on investments, you were to go direct on something, it might say to you, hey, you need at least 50 grand for this, you need at least 500 grand, whatever, right? Some investments have big tickets to get in. Whereas on platform, because they have a lot of people going to that investment, they get a better rate, and you might be able to get into the same investment for 10,000 or whatever. So that's the benefit of a platform. Really, it's just a nice, if you're not someone who really wants to spend all day trading and managing your shit, it's a nice little way to get everything operating. You set up all your rules and it can all happen from there, and you don't really have to do fuck all. All right, my favorite investment vehicles. So all the documents I attached to this session today is mostly about investment bonds because they are the most underutilized and underappreciated things out there, right? So investment bonds are a tax-effective investment solution providing flexibility, simplicity, control, and access at any time, okay? Second best thing to superannuation, except you can access it whenever you want. Investment earnings are taxed at a minimum effective rate of 30% rather than your personal marginal tax rate. So we talked about the second best tax rate being company structures after superannuation. You get that tax rate here. Investment bonds provide additional benefits to securely manage the transfer of wealth to the next generation. So what's an investment bond? Investment bond is essentially a minor superannuation product almost. It's something that it's an insurance bond essentially that you buy into, you provide a beneficiary, and you can invest inside it. Okay, so you can invest inside its own structure. It's almost like a trust, but it's not. It's its own, a bond is its own structure, and you put your money in. You can invest it inside there as aggressive or less aggressive as you want. You don't have as much flexibility as you do with other platforms, but you can still get some good ETFs, some good funds, and you can index invest, whatever you want. And what happens is this is really good tax effective strategy because one, it's internally taxed at 30%, okay? Tax within itself, right? That means that you never have to do a tax return on it, okay? It means that no matter what you're earning, it doesn't affect your tax rate, okay? This is only the start of it. So you also are allowed to input 125% of your previous year's contributions, okay? So that's a rule. You're allowed to increase it every year by 125%. If you drop down though, then you only get 125% of the year before, right? Which is shit. So you got to keep a consistent strategy behind it. But what happens is the real benefit of it is you can access it any time. If you want to pull it out straight away, so you invest and then you'll pull it out, all that will happen. So all your gains are internally taxed at 30%. Everything's taxed at 30%. You pull it out, whatever your tax rate is will be offset by the 30%. So if you are, if you're on 34.5%, you'll only have to pay 34. You only have to pay 4.5% on whatever happens inside there. Okay, really cool tax effective system to not get your income tax every year here, but also really good to make sure that as minimal effort as possible into your investment future. But what's the kicker? All right, the kicker is after 10 years, the bastard's tax free. And now I got years pricked up, right? Tax free. The only other tax-free investment that you can get is in superannuation, yeah? So this is internally taxed. You pay tax on the money that goes into it, but any gains and anything inside, if you hold that investment for 10 years, tax-free. At the 8th year, it's 33% tax-free, so 1/3 of it's tax-free. At the 9th year, it's at 66% tax-free, so 2/3 tax-free, and at the 10th year, it's tax-free, 100% tax-free. great strategy to use, if you're going to use superannuation from 60 onwards, great strategy to use from 50 to 60, right? Because you've got more than 10 years till you need it. By the time you get there, that money is going to be tax-free as well. So you're going to have a time frame of tax-free money from 50 all the way to when you die. Great strategy as well to also look at saving and investing in the bond, buying property and paying minimum off your property. Invest as much as you can in the bond because the bond will grow more. After 10 years tax-free, you take out your tax-free money, pay down the property, right? Pay down what would otherwise be taxed money. So really good strategies to utilize. On top of that, great for estate planning. You can put beneficiaries as your kids or whatever, and if it doesn't, creditors can't get it. So if you go bankrupt, they can't come to it. If in your estate doesn't form part of your estate, go straight to who you want, and you can set up rules. They get it at 25, they get this, whatever it is. It's its own little cool little entity for shit like that. Really cool little product, really cool little strategy that a lot of people miss because they don't understand it. We use them all the time. Brilliant for saving for kids' education. So if your parents, your sisters, your brothers, your family, your friends, you know people who are saving for their kids or some kids in a bank account, they need to look at investment bonds. Jump on Gen Life and have a look. They're crazy. Are these treasury? No. So different to treasury bonds. So treasury bonds or bonds as in like bonds, right? So just bonds in general as an investment class is debt. You're buying debt. Okay, that's what a bond is. An investment bond is different. They operate under the same sort of rules, but they're an internalized structure that have been sort of bastardized off the back of it to help create wealth in other areas. Okay, you're not buying debt, right? They're more like an insurance bond. An insurance bond is where essentially you buy into this bond and you pay premium after premium into the bond, and then if you don't use the premium at the end of a certain time frame, you get what's left in it anyway as an investment. They're more like that, but then definitely not treasury bond. Treasury bonds are debt. You're buying the government's debt and you're holding it for them, and they're paying you a premium to do so. So bonds, really, really cool. Make sure you, like I said, if you've got anyone who has kids that they're saving money for, or you are, or whatever, make sure they consider using bonds because they'll get 3 times as far in half the time. So some questions to ask yourself when trying to decide on what investment vehicle to use. 1, who should receive the income both now and in the future, right? That future question is so important. You've got to have an exit strategy off the back of any investment vehicle because it doesn't mean jack shit now, right? It doesn't mean absolutely nothing now if you're going to pay extra tax in the future. Who should receive the capital both now and the future, right? So everyone knows the difference between income and capital. Capital is the lump sum. Income is what it produces. Is there a need for investment assets to be protected against potential future creditors? No one knows the answer to that, but are you in a high risky industry? Have you got a risky job, risky business that potentially someone could try and fuck you over from? If the answer is yes, you really need to consider getting some asset protection. Are there special family considerations related to who should own assets or receive income, both now and in the future? What level of flexibility is needed as far as debt and leverage is concerned? So something to be considered when you're looking at trusts, companies, those kind of things. They're often affected heavily on how much you can borrow and lend through. So that's a downside sometimes, but it's also a bit more protecting that front as well. So you got to consider that. Usually the best lending is in your own name when you secure against your own property. What are the tax implications of each structure? So like I said, you always want to look for tax benefits, but if there's no tax benefits, is it still beneficial from an asset point of view? And what estate planning issues need to be addressed? So I've attached a quick little, your only homework this week is going to be to read through some of the documents I've attached. I don't want to feel like I'm pushing bonds because I don't. It's just they're very, very, very underutilized and misunderstood. If you guys can start your investment career off understanding that they're an option and where they should be an option, that really, really helps. So some of the documents we've got here is case studies for funding education. That's really important. Send that to people with kids that you know if you think they're saving in a bank account. Case study, so trust reducing distributable income. There's some really cool strategies for businesses around using a trust and a bond, so doubling up on that to try and reduce distributions. You think about it, if you hold a bond inside a trust, that's an asset you're allowed to. As a company, you contribute, right? As a company, you contribute your profits into that bond that are inside the trust. After 10 years, right, it's all internally taxed. After 10 years, you can pull those profits out tax-free. Yeah. So consider stuff like this. This is why it's really important to consider. Bankruptcy protection. So how can you use it because it's not affected by creditors? How can it be complementary to super, and how can it be used for transferring wealth? And then there's an overview on it as well. Some summaries on them. Who's good for a bond? High income earners looking for alternatives to superannuation. Retirees looking to create tax effective income streams. Need certainty with estate plan distributing wealth. People looking to qualify to offer improvement and government benefits. So bonds have a weird effect relationship with how they're treated for Centrelink purposes. There's different formulas around it. So yeah, it's actually, you could hide money in a bond, you actually get better Centrelink treatment. Looking to manage income levels in private trust, looking to invest for child's future or saving for funeral expenses. Great for funeral bonds. I'd like to use as a funeral bond as well. Here's some summaries on the three options. They're all a bond, but they sort of have different things on them. So tax and effective rate of 30%, nothing to declare on tax return, no tax file number, access to large range of investment options, etc., etc. Ability to make extra contributions. Everything you want in a good investment there, right? Now, don't get me wrong, there are some downsides to the bond. The main one for me is that they've got their investment portfolio isn't as high or available as Nicole's here. Hey Nicole, didn't see her. Is they're not as high as like in your own name, right? So just buying shares, you can do a lot more cool things, but you got to ask yourself, is the cool shit that I'm going to do, is it really going to be more beneficial than the tax benefits? Like you think about something that's tax-free in 10 years, whereas your investment, let's say your investment's worth $1 million in 10 years, right? Every year that even if you reinvest that income back into, or those distributions back into the portfolio, whatever income is distributed from your portfolio, you have to pay tax on, right? So you're going to lose 30% of it every time it distributes a dividend. Inside the bond, it doesn't. It stays within itself and it's taxed at 30% as a whole. And it gets its own CGT discounts and it gets its own distribution benefits and franking credits. Then at the end of the portfolio, let's just skip the 10 years. Let's say you want to take the share portfolio and sell it, right? You might not, but let's say you did. You take it and sell it, and you started your total gains 500 grand. Let's just say half of it's gain, right? And you're at 30%. Well, we're going to halve that 250, 25. You're looking at $75,000 in tax, right? So just by holding it in a different structure, we're straight up in front, significantly just by having that. So you've got to try and weigh up what the purpose is behind it and how long you're going to have it and help yourself there. Because if you don't know what you're doing, bonds can be great. I like bonds for education. I like bonds for long term, like it's in that 50 to 60 range. And then we kind of like to invest outside of bonds prior to that for a bit more sexiness. So before we wrap up, the last couple of things to sort of understand on today's session. Sorry that I went on about bonds so much. I do know when I do this session, I do go on, but they're so important. They're so underutilized. People just don't get them. If they're in the mainstream, or they'll be used all the time. So main things to think about. Think about the purpose of your investment. Look at which structure fits best, and then start in that structure as to not have a changeover later. So that's really important, right? One of the most costly mistakes for people is starting an investment, just going, oh, it's better to just get started. And then 5-10 years down the track, trying to switch it, paying stamp duty again and having to pay gains and everything like that, right? So think about ahead and think about all the way through to an exit strategy on that investment, whether it's a business, a property, a share, and actually think about what's the scenario I need to play here and what's the best way to do it. The biggest one is the small business CGT exemption. So if you're a business that wants to buy property or an active asset, you've got to be smart about that and have a good account on that front, because that active asset, if done correctly, held in the business over the lifetime, will be tax-free by the end, right? We just had a client buy their warehouse 1 billion years ago commercially inside their business, and they bought it for 500 grand and they sold it this year for 5.5 million, right? Redfern warehouse. Now you think about the capital gains tax on something you bought for 500 and sell for 5.5, even with a fucking 50% discount on it, that's still a $5 million gain, right? Which you're still getting taxed on $2.5 million. Yeah. So you're getting 30% tax on $2.5 million. Well, actually, it's more for them. So it's just over $1 million. By having it in that right structure, they saved themselves $1 million in tax because it was tax-free. Not only was it tax-free, we're then able to contribute that money into superannuation under that law, meaning that it then became tax-free income on top of that, right? So you've got to be really smart about what the purpose of the investment is and what structure fits it correctly. Okay, so takeaways and execution to finish up. So takeaway 1, understand the purpose of the investment. Takeaway 2, consider the options and weigh up your pros and cons. Just do a simple pros and cons list. Takeaway 3, don't discourage asset protection, okay? We're in such an era at the moment where cost. What's the cheapest? What's the best tax benefit? Tell you what, there's nothing more expensive than getting sued, right? Nothing more expensive than not being protected and losing the entire asset, all right? So don't try and skimp on cost at the start to save a few bucks on tax, just when it could mean that you lose the whole thing if something goes wrong. So what execution I want you to do? So I want you to assess any current vehicles you have for your investments. If you do have any, analyze their purpose, see if it fits. Make a list of what vehicles are and will be utilized for the next episode. So remember our discovery document, everyone? We did the discovery document. We broke that down. It's not homework, but I want you to consider what we talked about today. Think about your breakdown plans, okay? So your pre-retirement age, your retirement age, and think about what assets you might use for each one of those phases that might work better. What vehicles, sorry, what tax or investment vehicle you might use for each asset moving forward. Because the next session, we're going to talk about investment types, right? So if we can understand the vehicle, then we can understand the type to go into the vehicle. On the last one, if you have a bank account greater than your buffer, right, it's probably time to start investing unless you're trying to buy property first. So understanding these vehicles is really important to understand what you need to do in the next step. The only homework I got for you guys today or tonight is to read those documents and familiarize yourself as best as possible with those bonds. If you want more information on, the only reason I put the bonds in there and not the trust and stuff, because trust companies, they're all widely talked about. You can find lots of information on there. There's not a lot of information on bonds. So from anyone that's not in the industry. So if you want more information on trust, companies, that kind of stuff, let me know. I'm happy to flick through everything I can. But the bonds are in there because they're harder to find stuff on, and that's the best information that you'll get on them. So make sure you familiarize yourself with them. I wouldn't mind chucking in some questions next week to make sure you read them. But like I say, every week it's up to you. Next session, investment types. All right, any questions for today? What's your thoughts on Raise and Spaceship? Not really a vehicle, more of an actual investment. They're just fucking cheap, easy ways to invest in the market. They're not very sexy. They're cool ideas. They're cool ideas for everyday punters, but if you've got a real plan in place, we wouldn't use them. Spaceship's all right, but it's just an index fund, basically. They just buy. So Spaceship is just a Michael Cannon Brooks, I think his name is. He just started a company that's like cheap, easy access platform for young investors to invest in good international companies and good stocks, right? But it's just blue chip, like Apple, Facebook, and fucking whatever. And I think they have a roundup service as well now. He does superannuation as well. Really high risk because they're really leveraging off just top front running companies, but still good long-term profitability out of them. But it's not nothing special. It's nothing special. That's why it's so cheap. Raise is that, like, it used to be Acorns. So every time you spend, it'll round up 10, 20, 30 cents and invest it for you. Cool way for kids to get into investing, but it's probably more of like, I've seen it as more of a bad habit than a good one, because people start spending more money, and if they just had a good plan in place, they'd probably invest more overall anyway. But they're good ideas. They're good to start, but Alex, for people who come on board with us, we don't use them. I usually sell them out straight away and put them in proper portfolios. But they're better than nothing, right? That's what I will say. They're better than not doing anything at all. Okay. Any other questions? Come on, man. You're serious. We just covered off on companies, trust, and he's got nothing for me. Nicole, you got something. Come on, man. Oh, that's trash.
No, I actually don't. I came on a bit late, so I've just
noticed.
Yeah. I love how you did the shout out then as well, so then everyone noticed. No, I think it's really good. I think it's probably case by case. So I know I've got questions, but I think they're sort of, a bit more detail orientated. But no, I think it's good.
Click them through if you got them. Stefan, you're paying pretty close attention. Any thoughts? Anything you want to ask?
Sorry, can you hear me?
Yeah, man.
Cool. Not really anything that jumps out to me, to be honest. I'm still trying to wrap my head around trust and all that. And I've got some, like Nicole, I think I've got some questions that are like probably, I'm not sure if anyone else has like the similar sort of questions or is in a similar sort of situation.
That's what we're here for, to help other people. If you think they're too detailed, that might help someone. Ask them. That's what we're here for. Like, don't be afraid.
Right. So
you now then have to answer you privately because you're taking away money making time from me. You know what I mean?
Okay. Well, if you put it that way. So basically, like you said, you touched on it earlier. If you have an account that's bigger than your buffer, you should probably start investing. What if you don't? Can you still?
You can do whatever you fucking want. It's your money. But
yeah, of course.
I wouldn't, right? I wouldn't. Like this is what we sort of work on is trying to do things effectively. The first thing you need to do, like I put up a post today, people get really confused between financial security and financial freedom. Okay. They're two completely different things. Financial security is saying that if I've still got to go and work for my goals, but if something bad happened to me, I'd be okay. Right? That's security. It allows you to have the security that you can have a crack. And if things go wrong, and that's what we talk about our worst case scenarios, insurances, estate planning, etc. Financial freedom is the fact that you don't even have to get up and your life's sweet, right? Like you can choose whether you want to work or not, right? That's freedom. You don't have to pay a single attention. So where people say like pyramid schemes and fucking day trading is all financial freedom, it's not, because you have to work to keep that going, right? Financial freedom is simply if you turned your back on whatever it is making your money, you never have to think about money again, right? You need financial security to get to financial freedom. But we're so pulled up in the world of how sexy freedom is we just try and skip that step. But what that means is one thing goes wrong, we're fucked. So we always talk about achieving that first. And the first step, right, the reason that I'd say no to investing before savings is you need to have a 6-month buffer in place before you start investing, okay?
Yeah.
Because if you don't, whatever you buy to invest in, the first thing you're going to have to do if something goes wrong is sell that motherfucker. And if that's within 10, 20 years, we've wasted our time because that's where the real benefit of investing is. So if you set the buffer up first and then you start investing, when shit goes wrong, you can lean on your buffer rather than your investment.
Right. And so you have that buffer, it's all there. And you, because I'm still studying, I'm not someone who has like a steady income. You would, how would you weigh up the risk of getting security, like financial security and still investing? Or would you,
hang on.
What metrics would you use? How would you weigh up that risk?
In what way though? Like break it down. You're confusing me here. You're convoluting.
Okay. So say I've got a buffer.
Yeah.
But I still want to invest, but I don't have the steady income.
Yeah, but if you have the buffer, then you can invest.
But would I use that?
No, you wouldn't use the buffer. No fucking way. The buffer's there for emergencies so that any money you do invest is you can take risks with.
I see. Yeah.
So the buffer allows you to take more risk because if shit goes wrong, you've got a fallback option.
Yeah, okay.
Only time I'd invest a buffer, this is not financial advice. I know this has been recorded. Close your ears, everyone. The only time I'd invest a buffer is when there's a fucking crash in the market or a dip or a heavily valued stock. And I'd say, go all in, big champion. And we'd ride the wave and then we'd sell it back out and reuse our buffer, right? I've never done that, not once, heaps of times.
Okay.
Oh.
Is that it, Blake?
For me?
I think I want to, Stefan, do you mean like, are you asking him if he would recommend putting some aside for a buffer and putting some into an investment as like, you know, as you build that buffer? Or are you saying build the buffer first and then fucking go from there? Is that what you're?
Yeah, originally I was like, what's the step? Like, is there a first step and then a second step, or can you do both at once?
Yeah.
So yeah.
I would never do anything both at once, mostly because I'm a male and I can't do two things at once. But Jace will tell you, Mark will tell you, I like snowball strategies, right? When you start dipping your finger in too many strategies, at the start, right? At the start, I would always attack one thing. You don't have a lot of money at the moment, right? No one does, right? We're all young. We don't have heaps of money. So spreading our money thin isn't going to have much of an impact. So target one goal, pump the piss out of it, get it done, and then move that goal into something else. If you wanted to split it, I would say work towards a 3-month buffer first, and then start splitting your money between 50% of your wealth amount goes into the buffer and 50% is invested, but you need to have at least 3 months emergency there. Otherwise, like I said, the first thing you're going to do is sell an investment to try and fund your lifestyle, and you're never going to get nowhere.
Right. And what about the time frame sort of thing? Would you recommend like a long-term investment, or can you
I have no
split-
idea, bro, because I don't know what you're trying to do.
Right. So it's
Right? The investment needs to align with your purpose. If you need whatever that investment's trying to do, if you need that money in 5 years, find something that's going to be good in 5 years. If you need it in 30, find an investment that's going to be good in 30. If you need it tomorrow, fucking keep it in cash.
So it's got to, the purpose.
Your investment needs to align with the purpose. Stop trying to invest year to year and get the best returns. Find something that aligns in when you need the money.
Right.
Go, Nicole.
Can I ask a question? And I don't know if this has already been answered, so happy to skip. When last week you said, or at a point in time, you spoke about how investing in brick and mortar, being housing is not necessarily the best investment. So to someone looking to invest, what would you suggest in lieu of investing in brick and mortar?
Same answer as Stefan. Depends. What do you want to do? What's the purpose of your investment? Brick and mortar is a great investment if you want the things that come with brick and mortar. Stocks are a great investment if you want to go. So it depends on what your purpose is.
So can you go through that? So what would be the pros and cons at a high level of investing in brick and mortar and then looking at stocks?
Well, the high level pros and cons on the both. Brick and mortar, secure. You can leverage off it. Cons, it's not liquid. You can't touch it. You can't just sell the lounge room if you need money, right?
Yes.
Not very tax effective. Pros and cons, but that doesn't relate to any goals, right? The pros and cons should be in line with the goal. So let's say, for example, my goal is I want to buy my dream home one day, right? Well, why would you invest? You can, right? And we do this, but it doesn't really make a lot of sense to try and buy a stock to raise your money, hopefully in the future to be worth more than the property so you can buy the property. What I would do is I would buy a house that I can afford roughly in the same vicinity or that has a growth line in line with that property. And I would say that property, that investment's purpose is to stay in line with my future house purchase because I have a much better chance of that house reaching the same value as the other house that I want in proportion, right? Makes much better sense to buy an asset in line with that future goal that's a similar asset. Yeah. Why would I buy something in the hope of trying to make as much money as possible when I'm leaving most of my options up to chance here? That property could fall through the floor. If I'm trying to use it for money, right? If I want that property to make me as much money as possible, I don't have a crystal ball. I don't know if anyone wants to live there in 20 years. So I'm putting the majority of my future in the hands of everybody else. Whereas if I want to buy a $5 million mansion in the suburb, and I can afford a $2 million place on the outskirts that is in line with the growth pattern of that place, that's what I would do. Because regardless of if that $5 million place goes up or down, my place is going to move relatively in similar fashion with it. So I'm leaving the future of me up into my controllables. The only controllable I've got to worry about now is making more money and paying it down faster, not who's going to live there in the future. Yeah.
So in that case, then is the benefit of stocks liquidity?
Liquidity, flexibility, diversification. You know, like if you've got $1 million property, you diversify it in one asset, in one location. If you've got stocks, you can diversify across. It's liquid, you can get dividends. But again, aligning it to your purpose. Like
properties offer security because we know the stock market fluctuates like so. The property market doesn't necessarily.
Oh, you're in for a crack over chat next session. Does not. It does the same thing shares do. But we'll talk more about that in the next session. 100%. That's wrong. That's incorrect. It doesn't offer security in relation to volatility. Volatility is where markets do this, right? Yeah. They're the same. They do the exact same thing, and I'll show you why next session. It offers you security in the fact that even if it goes to zero, you still got something you can use. You can move into it if you have to. That's what the security does. It doesn't provide you security of value of money. You have no guarantee that that house is going to be worth anything more than zero in 10 years. It's likely, it's not guaranteed. The security factor is if it goes to zero, you can still use it for something. If you wanted to, you can pull it apart and use the parts to build shit, right? With the stock, if the stock goes to zero, the non-security part there is that you can't do anything with it. It goes to zero, you've got zero, okay? But they're arguably very, very minor cons in both factors.
I've got a question as well, if you're done there, Nicole.
Yeah, go.
So with the investment bonds, they get taxed like 30% and then pretty good, like nothing over fucking 10 years. My question is, if you had a company fucking named HUSLA, for example, and you somehow used a bond to offset your tax and you kept money in there, would you be able to leverage against that bond's value?
You can leverage against bonds, only some bonds. You cannot park money in there and not pay tax. So you have to pay tax at some end of the scale with any structure. In relation to a bond, you have to pay tax on the money before it goes in. Okay. So if we think about
Company.
just think about you as a person, right? Money comes to you, you pay tax on it, and then you invest it. Okay. The problem with that is you pay tax on it, then you invest it. Once it's invested, it then gets taxed at that rate again. Yeah, for any gain and anything it distributes. The benefit of the bond comes to you. You still pay your tax on it, but once it goes in, no more. Right? Once it's in there, then the tax stops. Whereas with a normal investment in your own name, the tax never stops. It keeps hitting you. It keeps hitting you. It keeps hitting you. Right? That's the problem. And then the compound effect of that is that as it gets bigger, everything else you're doing on the side, now your tax rate as a whole is going up. That investment over here is getting taxed more. That investment over here is getting taxed more. That investment over here is getting taxed more. It's not just one thing, right?
So can you feed profits of a company into the bond and invest with it through the bond?
Correct. But the company will still have to, it'll have to hit the company's tax line first. They'll have to pay their tax on it.
Yeah.
Then they'll have to purchase the bond as the asset.
But me as Jason Stupas can leverage against the bond.
Some bonds.
So is that a
not a very great leverage, not a very great leverage amount though. So property has the greatest leveraging ratio.
Yep.
Stocks aren't great, and bonds are probably the worst.
So with like ETFs and stuff, you can leverage against them more than the value. Can you leverage more than one times?
In what, the ETF?
Yeah.
Depends on the platform using. That comes more down to the platform, what they allow. So leveraging is more a platform question than an asset question. Yeah. Because when you leverage in a platform, that platform is the one funding you. So it's up to them as the lender on what risk they're willing to take. There's no real hard or fast rule. The reason we say property is the best is because that's you as a person generally going to a lender, the big lenders, the most common lenders, and saying, what will I borrow? And as a across the lending landscape, most people will lend against property better, then businesses, then shares, because there's a business, you own the business, then shares, and then bonds, fuck all. But when we're talking about ETFs, like you won't be able to take a portfolio of ETFs to the bank and say, lend me against this. You'll have to use a platform that lends internally because they'll need to take the individualized risk on it. Same as a bond. You'll need to use a bond that will allow you to leverage within it. You won't be able to go to the bank and say, hey, leverage against this bond. They'll go fuck yourself. They won't do it.
Yeah. Right. Well, that's going to be your job one day.
We'll be leveraging the piss out of everything. We'll be leveraging HUSLA to the moon, bye.
Fuck yeah.
All right. Any other questions? That was good. Thanks for engaging.
Yeah, if you're gonna
I knew you've all got questions. You're all just shy.
If you're gonna invest in ETFs for like a kind of longer picture, would it be best to just do it through a bond so you don't get taxed as much?
Could be 100%. So this is something. We're going to weigh it up, right? Depends on the ETF. So ETFs are good because
Vanguard or something.
Pardon?
Like Vanguard.
Yeah. So this is the thing. If we look at, usually most people use a diversified ETF anyway, but you got to look at the distributions, right? Look at the distributions. Look at how long you're going to hold it for. Because if you have like an Aussie equities ETF, for example, there'll be a lot more franking credits distributed through that. A lot more dividends because the companies that ETF holds will have more distribution, so you receive more distributions. Therefore, your tax will be more. Where you hold a global company, no distributions, right? No distributions will be all gains. So different again. Yes, you could do that. You've just got to weigh up that ETF is going to be more expensive inside a bond. Okay, so you're going to buy it at a higher price for the tax effective nature later. and you've got to weigh up the pros and cons around that. Okay, there's no hard, fast rule for any of it. Me personally, I use timeframes. So from 60 onwards, for me personally, is completely taken care of by my superannuation. Anything else I have left at that time, I can sell up and go on a bender, right? But then from 50 to 60, Mateo's like, I'm awake. What are we talking about? Anything from 50 to 60, I'll be funding via a mix of any portfolio that's left prior to that and my bonds from there. Okay. I'll also have bonds to fund my child education because it's a great way to do it from estate planning practices. That's the other reason I'd use bonds from 50 onwards, is because it's easy to pass on. Okay. Easy to transfer. Also credit protected, right? So my back end strategies, like 50 onwards, I have a lot of credit protection, because if my business fucks up and I get sued, at least I know they're still good to go. Yeah. As for like singular things like ETFs versus that, I probably wouldn't just hold an ETF in a bond for the case of holding an ETF in the bond. I would put it more towards its purpose. Is its purpose pre-retirement? Is its purpose education? Is its purpose retirement? If it's not, and you're just sort of winging it with it, just hold it in your own name.
Okay.
Okay.
Yeah, cool.
This way, you really need to put portfolios together in sections, not just one portfolio to go. Like, what's its purpose for here? What's its purpose for here? We call it bucket strategy. We do the bucket strategy with our cash flow. You've got to do the bucket strategy with your investments as well.
I was more so thinking that if the dividend repayments are compounding, like within the bond, and then when you're ready to sell up, you're not paying any tax on it with all that compounded.
Correct. And the other benefit inside the bond is that actually the franking credit will offset. So if you get a franking credit of 27%, right, then the bond only has a 3% tax arbitrage. It only has to pay 3% tax on that, because that 27.5% was credited against it. So that'll stay inside the bond, and that'll compound as well. And that'll continue on all the way until the 10 years. So yeah, that's the benefit of the bond. That is 100% the benefit, but there is a higher cost to it. And you've got to take into consideration a bigger picture of your portfolio, because there's other considerations around it, like the contribution rule. You can only do 125% of last year's contribution. So if you get this big lump sum of money, you want to chuck it in there, well, you can only put in 125% more than what you did the year before. Anything else, you have to start a new bond, and that'll trigger another 10 years.
Yeah.
Right?
Yeah. Cool. Thanks, mate.
No worries. Anything else? No, cool. All right, guys, I'll let you go. That was a cracker sesh. Well done. Next week, we will be talking about investment types. That's where we'll go into, let me just double check. Yeah, that's where we'll talk about property, asset classes, cash, term deposits, bonds, like as in credit bonds, domestic shares, international shares, domestic property, residential, domestic property, commercial, international property, listed versus unlisted businesses, active versus passive, and type of investments like managed investments, SMAs, ETFs, etc. Okay, probably a long one next week. Cool session, but all right, if we're all good, I'm going to go. All right, love yous, leaders. If you've got any questions, reach out throughout the week. Make sure you read those things. I'm here for you. I'll speak to you soon. Peace out. A-Town.
Thanks, Ryan.